is that when they're married or together, as you can see in this chart coming up here, there is a married filing jointly tax status. And as you can tell, the income amounts are much higher than the single tax status on here. However, as you can see in this chart, when someone passes away, they now go from the married filing jointly tax bracket to the single filing jointly tax bracket, which means that the income amounts they had prior could be taxed more. Here's an example on this chart. Let's say they had $100,000 in net after-tax money for annual cash flows while they're married or they're both alive. One spouse passes away, that surviving spouse now still has that $100,000 they want to have in net cash flow. However, because they're in a single tax bracket, they are now taxed more. So now they have to take out more money from their investment accounts to still net that same $100,000. Now, again, I've seen this happen quite often on here, but we could be proactive on here. Instead of having all your money or too much money in IRAs, 401ks, TSPs, and more, we can have more money in that Roth IRA account. So now that that money's in that Roth IRA account, when someone does pass away, say spouse one has a Roth IRA of $2 million, they pass away, that surviving spouse gets an inherited Roth IRA. So even though they're now in that single tax status, it's still a Roth IRA, it's inherited, that's tax-free money. So that surviving spouse doesn't have to worry about extra taxes. They could still take out that net $100,000 cash flow without worrying about taking out more money. So again, that Roth IRA is very powerful for that surviving spouse who's left on there an inherited IRA.